Silver did not just fall on January 30, 2026. It was slammed off a cliff. In a matter of hours, the price collapsed from $121 to $70. $51 vanished in a single session. Not a slow pullback, not a healthy correction, a violent air pocket. The biggest one-day destruction in silver since 1980. And while traders around the world were being liquidated in real time, one man was sitting on the other side of that panic with a massive short position and a profit that may have reached $144 million. But this is bigger than one winning trade, because the deeper you look at what happened next, the uglier the silver market starts to look. Global markets were already fragile. Then the shock hit. More than $7 trillion was wiped out across assets in roughly 48 hours. Retail accounts were getting margin called into oblivion. Futures traders were forced out. Dealers from Dubai to Switzerland were reporting empty shelves. Physical buyers could not get metal. Paper traders could not get out. And right in the middle of that chaos was a mysterious Chinese metals whale, operating far from Wall Street, far from London, far from the cameras, holding what appears to have been the largest silver short position on the planet at exactly the right moment. He was not doing television interviews. He was not posting victory laps. He was not explaining himself to anyone. He was simply positioned, calm, disciplined, and terrifyingly early. According to reporting that came out days later, his paper gains from that move were roughly $288 million at one point, with net profit after earlier losses estimated near $144 million. One trade, one collapse, one fortune made while the rest of the market was still trying to understand what had just hit them. And here is why this matters. This is not just a story about a billionaire making a brilliant call. This is a story about a market fracture. A fracture between paper silver and physical silver. A fracture between what the exchanges say metal is worth and what real buyers are actually paying. A fracture that, if it keeps widening, could change the entire precious metals landscape. Because what happened on January 30th was only the first act. The second act is what happened in the physical market after the crash. The third act is what came out of Shanghai on February 5. And that third act is so extreme, so abnormal, that it may be one of the most important commodity data points of the year. Almost nobody is treating it that way. They should be. So let's start with the official explanation, because this is where the misdirection begins. The mainstream story was simple. A hawkish Fed narrative hit the market. The dollar surged, precious metals sold off. End of story. Clean, tidy, convenient. And yes, that explanation contains a sliver of truth, but only a sliver. Because if this was only about the dollar and rates, silver should not have been obliterated while gold merely suffered. Silver got hit dramatically harder. Gold dropped. Silver was thrown off the roof. That asymmetry is the giveaway. When two assets are tied to the same macro story, but one gets crushed 3 times harder, something else is happening underneath. Something more mechanical, something more leveraged, something more dangerous. And that something was a liquidation cascade. Heading into that week, speculative positioning in silver was stretched. The market was crowded on one side. Leverage was high. Expectations were hot. Silver had already gone parabolic, running from roughly $30 in early 2025 to above $121 by late January 2026. That kind of move feels unstoppable, right up until the exact second it stops. Then the trigger arrived. Large leverage products were forced to rebalance into weakness. Huge volumes of selling started hitting the market. Margin requirements were raised during the slide, which is the financial equivalent of throwing gasoline on a fire. If you are leveraged and margins jump while price is already falling, you do not get time to think. You either post collateral instantly or your position gets dumped for you. That creates more selling. More selling triggers more margin calls. More margin calls create even more selling. The chart turns into a trap door. That is what a death spiral looks like in real time. And this is exactly the kind of environment where a disciplined short seller can make a fortune. Now we get to the man at the center of this story. His name is Bian Ximing. If you have never heard of him, that is part of what makes this story so unsettling. He is not a celebrity investor. He is not one of those loud macro personalities who spends all day posting predictions. He is a Chinese billionaire metals trader with a record that demands attention. Over the past several years, he reportedly made more than $3 billion trading gold on the Shanghai Futures Exchange. That alone would make him formidable. But what changes everything here is that this was not a permanent silver bear making one lucky bet. He had profited on the way up before flipping and profiting on the way down. That matters, because it suggests he was not married to a narrative. He was reading structure, leverage, and timing better than almost everyone else in the room. Exchange data indicated that positions connected to his brokerage were building aggressively ahead of the collapse. The short exposure expanded sharply in the days just before the peak. By the time silver was topping out, that short had swollen into something enormous, roughly 30,000 contracts, equivalent to around 450 tons of silver. Read that again. At the exact moment silver was peaking, while the crowd was still euphoric, one of the most successful metals traders alive was leaning heavily the other way. That does not prove conspiracy. It does not prove inside information. But it does prove that somebody with a remarkable record saw something in this market that others either missed or ignored. My view is that he saw the same thing the chart was quietly screaming. Silver had gone vertical. The rally was real, but the leverage underneath it was becoming unstable. When price goes up too far too fast, the fuel that drove the rally becomes the fuel for the collapse. The same traders who chased it higher become forced sellers on the way down. He understood that. He positioned for it. And when the avalanche came, he was waiting. But here is where the story turns from impressive to disturbing. Because if that were the whole story, this would just be a brilliant call. Instead, the physical market started sending a completely different signal. While paper silver was collapsing, physical silver was refusing to follow in a normal way. This is the part that should make every serious metals investor stop and think. On February 2nd, the same ounce of silver was effectively being priced at wildly different levels around the world. In New York, paper silver was around $80. In Japan, that same ounce was changing hands near $120. In Shanghai, it was above $111. In India, higher. In Kuwait, higher. In Dubai, buyers were paying steep premiums and still struggling to secure supply. Same metal, same planet, same day, completely different prices. That is not what a healthy market looks like. In a functioning global commodity market, those differences should be attacked by arbitrage. Traders should buy the cheap metal, move it, and sell it into the expensive market until the gap closes. That is how the system is supposed to police itself. But this time, the system did not close the gap. Why not? Because the economics of moving the metal were broken. Lease rates had surged, borrowing costs were high, freight mattered, insurance mattered, time mattered. By the time you added up the real-world frictions, the theoretical arbitrage was no longer a clean profit. The mechanism that is supposed to keep global prices aligned simply failed. That is a huge deal. Because once arbitrage stops working, paper can say one thing and physical can say another for much longer than people expect. And when that happens, the chart you are staring at may no longer reflect the reality of the asset you are trying to buy. Then came the dealer reports. Dubai was running dry. Swiss dealers were reporting no silver stock. Not low stock, no stock. Metal coming back from sellers was moving out almost immediately. New buyers were hitting a wall. In some places you could still get a quote, but not real availability. In other places you were paying massive premiums just to secure bars. Now connect the dots. The futures price is crashing. Physical buyers cannot get product. Premiums are exploding. Regional markets are dislocating. And the paper-to-physical ratio on major exchanges is already stretched to a level that should make any rational person uncomfortable. This is where the narrative starts falling apart. If silver were truly in a simple fundamental bear market, physical metal should not be behaving like a scarce wartime resource while futures are being torched. Those two realities do not belong together. One of them is telling the truth. The other is distorting it. And then February 5th happened. This is the moment almost nobody is covering with the seriousness it deserves. That morning, silver futures trading in Shanghai exploded to a level so absurd that many people thought the number had to be wrong. On one contract alone, more than 1.39 million lots changed hands. Each contract represented 15 kilograms of silver. Do the math and you get an amount of silver equivalent so large it starts sounding fictional. Add in the other contracts traded that session, and the total paper volume represented roughly 1.34 billion ounces. In one morning, on one exchange. That is close to double annual global mine supply. Pause there for a second. The world mines roughly 800 to 850 million ounces of silver in a year, and yet in one burst of trading, a market processed paper silver equivalent to far more than that. If that does not tell you this market is operating on layers of leverage, abstraction, and synthetic supply that have detached from physical reality, nothing will. And here is the most important part. Even after that avalanche of paper selling, even after all that pressure, the Shanghai premium did not die. That is extraordinary. Normally, if you dump that much paper onto a market, you expect it to crush everything in sight. You expect the premium to evaporate. You expect fear to spread. Instead, the physical tightness survived. Shanghai still held above New York. Backwardation persisted. Near-term metal was still commanding more urgency than future delivery. That is the market screaming that physical silver is still tight no matter what the paper says. Paper attacked. Physical refused to surrender. That is not a normal signal. That is a structural signal. And the warehouse data only made it worse. Inventories on the Shanghai Futures Exchange were falling fast. Real metal was leaving the system. Not claims, not contracts. Metal. Stocks had fallen dramatically from their historic highs, and the pace of decline showed that industrial demand was not theoretical. It was active, visible, and persistent. So now, step back and look at the full picture. A whale times a massive short almost perfectly and makes a fortune. A leverage cascade detonates paper silver. Physical silver disconnects globally and trades at steep premiums. Arbitrage fails to close the gap. Dealers report empty shelves. Shanghai trades insane paper volume and still cannot kill the premium. Warehouse inventories keep falling. At some point, this stops looking like a normal correction and starts looking like a market that is splitting in two. And that brings us to the structural issue nobody in mainstream finance seems eager to discuss. Silver is no longer just a monetary metal or a legacy precious metal story. It is now deeply tied to strategic industrial demand. Solar panels consume huge amounts of it. Electronics need it. Advanced manufacturing needs it. AI infrastructure, power systems, medical equipment, EV supply chains. All of it leans on silver in ways that are difficult to replace because the physics are stubborn. And supply is not elastic. You cannot just decide to create a new silver mine next quarter because price is high. Even with strong incentives, new projects take years to bring online. Permitting is slow. Financing is slow. Construction is slow. The supply response to current demand is not arriving tomorrow. It is not arriving next year. In many cases, it is not arriving until the next decade. That is the timeline problem. Demand can surge now, supply cannot. And while that is happening, governments and major corporations are behaving in ways that reveal what they really think. Export controls tighten. Strategic classification appears. Industrial players go directly to mines instead of trusting the exchange system. That is not what smart money does when it believes metal is abundant. That is what smart money does when it fears future scarcity. That behavior matters more than the headlines. Because the headlines tell you silver crashed. The behavior tells you serious players are trying to secure actual metal. Those are not the same message. Now let me be fair to the bear case because it exists. The macro environment can stay hostile. Higher rates can pressure metals. A stronger dollar can hurt sentiment. Silver had undeniably gone too far too fast. A parabolic move is vulnerable by definition. And when someone with Bian Ximing's track record takes the other side, you do not dismiss that lightly. But even after granting all of that, the physical market is still not behaving like a clean bear market. That is the key distinction. The January 30 collapse looks far more like a leverage event than a true fundamental unwinding. Price got hit because positioning was fragile, not because the underlying scarcity vanished. In fact, almost every physical signal says scarcity is still there. Premiums, inventory drawdowns, lease rates, regional shortages, backwardation, direct sourcing by industrial users. None of those data points look like a market where abundance has suddenly returned. They look like a market where paper broke first. And in commodity history, when paper and physical separate this violently, it usually does not end with physical giving up and admitting it was wrong. It ends with paper being forced to catch up. That is why this story matters so much. It is not just about whether one trader made $144 million. It is about what his winning trade revealed. It revealed just how unstable silver had become. It revealed how much synthetic pressure can hit the price in a short window. And it revealed that even a massive paper assault may not be enough to erase physical tightness once the real metal starts disappearing. That is a dangerous combination, because if physical demand keeps tightening while futures remain the main price-setting mechanism, the next major move could be even more violent than the last one. Not because the fundamentals changed overnight, but because the system setting the price is increasingly detached from the thing being priced. And that is when markets get unpredictable. That is when trust starts to erode. That is when people stop asking what silver is quoted at and start asking where silver can actually be bought. Those are two very different questions. So here is the bottom line. January 30th was not just a crash, it was an X-ray. It exposed leverage, it exposed fragility, it exposed the gap between paper silver and physical silver. It exposed how one elite trader can make a fortune by understanding crowd positioning better than the crowd understands itself. And it exposed something even bigger than that, something far more important than a headline about a spectacular short. The silver market may be pricing two different realities at the same time. One reality exists on screens, where contracts can be dumped in volumes that dwarf annual mine supply. The other reality exists in vaults, dealer networks, industrial supply chains, and export pipelines, where actual ounces are harder to find, harder to move, and harder to trust the system to deliver. Eventually, one of those realities has to dominate. So now the real question is not whether silver had a historic crash. It did. The real question is whether that crash was the end of the story, or the event that finally exposed how broken the market structure has become. And that is what I want you to think about. Was this just a brilliant call by a world-class trader who timed the top? Or was it a warning shot that the silver market is entering a phase where paper volatility and physical scarcity are going to collide in ways most investors are completely unprepared for? Drop your view in the comments. Was this move pure skill, pure structure, or something even bigger unfolding under the surface? And if you want more breakdowns like this, subscribe now, because this story is not over, not even close.